Welcome back to Golden Rule Radio. We're recording today on June 19th, and not a whole lot to report as far as the precious metals go. We like to start with a weekly summary or weekly recap. Last week, gold 2003.26. Now it's 2003.30. Silver was 29.74. It's 29.71. Last week, 967 on platinum, 988 now, probably the biggest mover, because palladium was 923 and now it's 924. So you guys, I think that's about as flat of a report as we've ever given. Maybe we should do this as a monthly show.
Yeah, I mean, we did have a little bit of volatility, but when I say a little bit, I mean a little bit. I think gold and platinum's entire range was like $30-$35 top to bottom. Silver had about an 80-cent, 90-cent move, so it had a buck up and down, but still, if you end up in the same place, who cares? Over on the equity market, however, we did have a little bit of movement with the S&P up about 2.5% and almost hitting that 5,500 number. I think we're finished up the day yesterday at 5,490. The Dow Transports, which is, I like to keep an eye on. Are we shipping goods too, or are we just trading the stock price? And the Dow Transports had a very volatile week last week. The total range from top to bottom was about a 5% move up and down in a week. So that's pretty significant. It did continue its downward slide, which it has actually been doing since about 2021 or 2022. So the transports remain pretty significantly below the old highs, the post-COVID highs, where you've got the S&P continuing to march forward. The transport's still down 15-18% from the previous highs. So two different worlds in one market. I don't think we can blame everything on gas prices.
No, the metals have led the charge, but the equities, we may see a further climb here. In the late stage of a bull market, you see a melt up. That's just the way it tends to be. And whether we're in that now or not, keep in mind that if it weren't for the Mag 7 stocks, we'd be in lackluster performance as far as the equities are concerned. And they're carrying everything. And in fact, those 7 stocks now have a combined market value of over $15 trillion. And they're now equal to 50% of the GDP. That's dangerous. It's not healthy. It's a bubble. It's comparable to the tech stock bubble, the late 90s and 2000, even if it's founded on a little bit better, legitimate long-term technology. But all that to be said, that's up 60% in the last 12 months, and that's what a bubble is. And the metals kind of preceding that run, to me, we're getting really close to the edge here as far as a downturn in the equities. But the global markets are trying to figure out what's going on. So you see bond yields swinging, the bond market swinging volatilely. You got monetary policy all over the place. You've got a housing slump in China. In fact, home prices fell 0.7% in May, which is the 11th straight month, and the steepest drop since 2014. Dr. Copper, Rob, which you like to talk about, just put in an 8-week low. And so I don't know that anybody really knows where this is going. And compound that with a U.S. election year and things really starting to heat up, and we've got all sorts of unpredictables.
We do. There was some headlines that came out that one of the big banks in Japan is going to have to sell $63 billion worth of U.S. and European bonds. And they're pointing to the banking sector here in the U.S. that are sitting on $500 billion worth of unrealized losses. So they're saying, okay, this is going to start a run. Everybody's going to bail out of U.S. and European bonds. But Miles, put that $63 billion in perspective. Even if it was all just U.S. Treasuries, what does that really look like?
Before I do this, I think you just hit the nail on the head with, could it start a run? Because you don't start with a 10-foot tall snowball at the top of the hill.
True.
You start with something the size of your fist, and it gets to 10 feet tall when it gets to the bottom. Okay, so 63 billion sounds like a pretty big number, but putting that in context, the U.S. government spending year over year in 2023, the fiscal year, so October to October 2023, was $6.5 trillion. So if you look at the entire government spending over the course of the last fiscal year, right, October to October was like $6.5 trillion. Well, that's $541 billion a month. What's $63 billion? That's a couple days of government spending. And then you look at that in terms of just the national deficit that we added in that same fiscal year, about 1.4 trillion. Well, that's 116 billion a month. So it's significantly less money, I think, than the average person would consider. It's going to sound like a big number because we don't tend to deal in those types of numbers as just normal run-of-the-mill people. I mean, unless you're Elon Musk, you don't really know what a few $1 billion looks like. So from that standpoint, it sounds like a big number. It's not. We're talking about the biggest, most powerful country on the planet. It's a drop in the bucket. So I actually have a better question. Other than just could it signify a unwinding of things, which everybody is really paranoid about the next unwinding because we remember what happened in the 2008 unwinding. So I don't think it's unreasonable to be hyper paranoid about the snowball building up momentum.
And I agree with that. I mean, just because we're paranoid doesn't mean they're not after us, okay?
Fair.
Doesn't mean you're wrong,
Right.
right?
Yeah.
But we have to put it in perspective. The biggest issue that I struggle with is the fact that we are surrounded with really serious issues, whether it's social issues or financial issues or looking at our election. You know, we've got a presidential debate coming up in a few more days. This is make or break for the Biden campaign. I think the Democrats desperately want to move him exit stage left. What do you guys think?
Yeah. We're 8 days away from, to me, what could likely be the final straw. They're parading the president out publicly now, which was not the case over the previous 2 years, really. You know, his cognitive decline is real. And to me, it just represents the fact that I personally do not believe he's going to be the candidate. And we've said that before on this show, that this isn't going to be what the election is. I think the timing of this debate on the 27th is purposeful before the conventions, and we've all been bracing for 2024 as a country,
Right.
because of the election, because of the fallout from the last election, because of the expected fallout from this election, regardless of how it goes. I don't even think these two are going to be the two on the final stage. I mean, I think it'll be Trump versus somebody else, right? And so that's going to rile the markets a little bit.
Yeah, because markets do not like uncertainty.
That's right.
And we are surrounded with uncertainty. We're surrounded with very serious issues. So I don't want to poo-poo people that are out there pointing to the fact that Bretton Woods is pretty well done. There is no more petrodollar. The BRICS countries are meeting again in another couple of weeks. And you're seeing over 100 countries now wanting to join that BRICS polar shift away from the U.S. and European market into their own market, their own currency. Gold is a very strong drive into the BRICS revolution, if you want to call it that. So we are seeing the world changing.
Yes.
And for our listeners, they need to figure out how are they going to prepare for a changing world where the United States is no longer what it was 10 years ago. You cannot drive your car by looking through the rearview mirror. You have to look through the windshield, and the windshield's pretty dark.
Well, what are the ultra wealthy doing?
Well,
They're selling stock, they are buying land, and they are buying gold.
yeah.
So if they're doing that, then we should be doing that. And so you reduce your paper exposure. And Miles, I hear your point about a drop in the bucket, circling back to the bonds that are being liquidated. Those treasuries auctions aren't going well already. Our U.S. Treasury auctions are faltering.
But I'm
This
looking at
is-
the balance sheet, and the balance sheet from the top, I think we were like 9.5
At
trillion.
the Federal Reserve.
Right. And
Yeah.
it's now down to around seven.
Yeah. So
barely
that's an
above.
improvement of tightening, but that doesn't mean that Washington's spending has been reined in. And the
No.
Federal Reserve is saying if Washington were to control spending, we wouldn't have nearly the problem that we're facing right now.
Well, I mean, arguably it has been reined in since the absolute peak back in, 2020, 2021? Okay, so I mentioned a second ago when we were looking at the numbers, last fiscal year we capped out at 1.4 trillion new debt. We're already at 1.2 in this fiscal year. Now, again, that's October to October, so
Yeah, we're
more
halfway
than
there.
halfway through.
Yeah.
But
Right.
we are going to increase the deficit more in 2024 fiscal year than we did in the 2023 fiscal year. Why? I thought things were fine. Why are they spending more money?
Let's take a look at the velocity of money. Miles, can you pull up velocity of M2 money supply?
That I can do.
So you're right. The velocity is key. The more money in the system is one thing.
If
The
it's not
faster it's
turning
moving
over,
around.
if it's not turning over, that's a huge sign. If the velocity is picking up, inflation is coming hard.
Which was a big issue following the COVID stimulus.
Yes,
So
yes.
the velocity started to pick up and people started to spend rather than save. They've blown through all those savings already. So
Yep.
the velocity picked up. Now it's slowing way down
Yep.
because people don't have what they had in
Right.
terms of discretionary spending, and they can't borrow like they were borrowing. And so that's part of why you continue to see, Miles, the increase in the monetary stimulus, if you will, on the part of the government.
But they're pushing on a rope.
But they have to hire, they have to create jobs
Yeah.
because jobs aren't being created otherwise. So the government steps in every pre-recession period of time. The government steps in, starts hiring, and the government starts spending to stimulate the economy. They've got to try to stimulate GDP, and it shouldn't even count in the GDP numbers. Government spending, to me, should fall out of that, but it's not. So what did you find in terms of velocity, Miles?
So velocity has obviously been decreasing since the late 90s. We've gone from 2.25 for every dollar down to 1.3 today. But what's interesting, we dipped almost 1-to-1, 1.0 back in, obviously, first quarter 2020. The whole country shut down. So obviously the velocity of money, the turnover of money is going to tank down to bare bones. Stimulus boosts it back up. But as of right now, Rob, and this gets to your point a second ago about is it continuing or is it turnover? I would argue if you look at the 10, 15-year trend on velocity of money, we're back up to that trend line. So it's very likely you're going to see velocity actually start turning down again, even though for the last couple years it's taken a pretty big jump back up. We're where we would have been if we had followed the trend and COVID hadn't happened. So velocity of money is back to where the trend, which really started back in around 09, this sort of flattening, a flat decline since about 09, we're right back to where we would have been had COVID never happened. So I think you could see velocity roll over.
Well, the University of Michigan consumer sentiment reflects that, right? It's down surprisingly 4 points lower than what was expected. That came out of left field. Well, we're all feeling it. You didn't talk about the monetary security. We just kind of circled around that. But the BRICS is an attack on the petrodollar and the U.S. dollar world reserve currency status. Okay, there's another insecurity. And then geopolitically, obviously, there's left and right insecurities. I mean, tensions with Russia building, tensions with China continuing to build. Now China's got economic woes on top of Japan's economic woes. We've got our own economic woes. This doesn't bode well on the geopolitical front, much less the domestic front. So now our own Homeland Security is saying we are at an incredibly high risk of a domestic terrorist attack. So get ready. They've already foiled, we've seen 3 stories in 3 weeks. What happens there? I mean, how does that obviously impact our markets? And what happens? What is the snowball that gets the equities markets rolling? That's where I'm worried here, that there's been so much money pumped into just the tech stocks, and everything else has been telling a different story, including gold.
Well, in gold, the 200-day moving average, Miles, isn't it over 2,100?
Yeah, we are.
That's a solid number. And gold, even though it's unexciting and flat here in the low 2,300s, our floor continues to rise.
That's right.
So I am not worried about the price of gold. In fact, I love the fact that we're moving sideways like I thought we would into the summer months. There for a minute, it seemed like it was heating up, but then it cooled right back down. We're moving sideways. I know Russia's probably selling some gold. They're having some big financial issues over there. So I think that gold is absorbing whatever central bank is selling into it. I'm thinking Russia is a major seller right now. We'll find out soon enough. But it's not affecting the price of gold.
Well, David McElvaney points out on this week's weekly commentary that developed nation central banks are now starting to join the developing nation central banks
And
in
buy.
acquiring gold. So we've talked about this. When will it finally move from west to east?
Starting.
It did that, and then now east to west, can we start to play a little bit of a catch-up, and especially with the de-dollarization going on. So that's one moving average. The 50-day moving average is 2,340 or so. We're just a little below.
Yeah.
And that's just a huge number. I like where we are now more than when we were at 2450, because when you're that far disconnected from a moving average, you know there's going to be a slight, if not moderate, correction.
Yeah, very moderate.
Yeah, that's fine. But we're always one news event away. We can trade sideways and just do this sideways chopping all summer, unless we're one news event away constantly because of all of that undercurrent, all the underlying fundamentals that have been aligning and building unlike any point since World War II in U.S. history here.
Oh, yeah, and it's heating up. I mean, we still have Israel and Gaza. We still have a border infraction between North and South Korea. That's happening. The situation in Ukraine with Russia and the European armies and supplies flooding into Ukraine. We are in a very unstable geopolitical world right now.
No doubt. And add to that the complexities of the U.S. domestic political scene, along with the debt issue and the attack on the dollar. And those are all reasons, again, why you're seeing the ultra-wealthy buy land, buy gold, and decrease their paper exposure, take the profits and convert it into a real store of value. It doesn't matter if you have $500. You need to be doing the same thing.
Yeah. I mean, if you look at our vaulted account, it's perfect for the guy that's only got 50 or 500 bucks. You can park it in gold, build your account to 10 or 20 ounces, and if you want to deallocate without tax consequences into delivery, you can. And it's physical to physical. So, it's a great program for the little guy. The larger client should be taking a look at the U.S. $20 gold piece market. You can buy uncirculated Saints and Liberties for the same price or better quality, 7 to 9% more than a Gold Eagle. That continues to shock me that premiums are this low for uncirculated or better quality Saints and Liberties. I can't believe those numbers. We're talking $2,550 to $2,700 a coin for coins that are 90 to 130 years old. That just doesn't happen. Not these kind of premiums.
Well, on top of that, Rob, obviously we're seeing a fantastic opportunity in certain gold coins. There's always an opportunity in there. It's just keeping track of which side of the seesaw you're on. Well, same with gold and silver. With the gold-silver ratio increasing back up, we had to move from 90 down to 70. We're back up, pushing towards 80. Maybe we get it a little bit higher again. And we're seeing some play within certain aspects of the silver market. I know some of our clients are taking a look at, say, junk silver again compared to bullion silver, because we're looking at some lower premiums in that products as well. And all of us remember what happened to coin premium in 2010 and 2011.
They went crazy
when there was no product availability out there. So the opportunities are going to be in there.
Yeah, people are paying 20% premiums for Krugerrands.
Yeah, it's COVID premiums on Silver Eagles, but imagine that on almost everything, not just the one product.
There's really no supply. Like, Tori, you were talking about the move from east to west as far as big banks and central banks moving into gold. You have the U.S. market wake up and start spending money into gold and silver products, whether it's bars or coins or 100-year-old coins. It doesn't matter. There really isn't enough out there. It'll change the market within a week.
Rob, there is so much money out there.
So much money.
Since 2009, 10, you guys are talking about these 9, 10, 11 dates.
There's so much money.
The money creation since then is unfathomable,
and
right?
It's
Whether
sitting
it
in
comes
money
from
markets,
cryptos, it's just sitting there.
Cryptos,
And the gold price is at a total value. We're at $2,300. Are you kidding me?
We should be at $3,800.
It sucks up the ounces so much faster when somebody's parking 10%. If 10% of a portfolio is what is necessary to do a minimum hedge, I mean, I kind of question that, because if the markets really crash, what's 10% going to do for you if that's your total exposure to gold? But think about how fast that sucks the availability of products dry. There
We've seen
is
it.
so much more money. We can't look back and compare to other dry periods because the price hasn't changed enough. If gold was at 6,000 an ounce,
Okay.
then we might be saying, okay, we'll see a similar type of an effect. It's still discounted at 2,300, despite the trillions and trillions of dollars in the market. So that's why you've got to be ahead of it. Buy the dips, buy when it's quiet, buy when the premiums are slow, the interest is down. Do not wait, because if you wait until it's too late, obviously you're going to overpay, but you're going to get stuck with product that isn't your ideal product, and or you're going to just have great regrets.
Well, that's been my one problem with the American consumer, is that we are used to, okay, when I'm ready, I'll just buy what I want. That just-in-time mentality. I'm going to wait until I know for a fact which way we're going, and then the world will be my oyster because I have my checkbook out. Not necessarily the case. I have seen it repeatedly. This will be the fourth time that I have seen when people finally get driven, the product is gone. The shelves are bare.
That's right. You do not buy a hedge when it's overvalued. If your hedge is going to work, you buy it when it's undervalued. You buy it when it's at a value.
When it's quiet.
Yes, and I'm sorry that you may disagree, listener, that 2,300 is a value. It's a value. Okay, it's coming. We're going to have a run to 2,750 in short order.
Yeah.
And you're going to regret that. Yes, we may ultimately correct again, but these are the opportunities where the hedge is undervalued. You get ahead of the curve. You have the product that you want. You get positioned now.
The product that you want. That's an excellent point. There's so many different aspects in this market to consider. I had a lady who's done very well, started buying 25 years ago from me. Rob, what do you recommend? I put 3 choices in front of her. I said, you've got great opportunities. You can look at junk silver. You look at $20 gold pieces. You can look at fractional gold coins, either U.S. bullion or 100-year-old European. The prices are the same. So you have so many things to choose from. It's a great time to look around.
So that's going to do it this week with Golden Rule Radio. We appreciate you stopping by. If you'd like to spend some time looking around at the great opportunities in the metals market today before things get out of control, how about give Rob, Tori, myself, or any of the other advisors at McIlvaney Precious Metals a call? We can be reached at 800-525-9556. You can also find us on Twitter at ICA Gold or Facebook at McIlvaney Financial. Our website is McIlvaney.com. Thanks again for listening. Have a great week.